Hi, my name is Bjork. Thanks for tuning in for the second quarter edition here of Student of the Market in 2023. The role of my firm is to serve as the independent investment fiduciary advisor for your organization's workplace retirement savings program and to help support the important decisions you're making not only within that plan but beyond. So with that, let's kick off the summer here with a very short condensed edition of Student of the Market and let's look at what U.S. stocks have done year to date, right? So if we take a look year to date, U.S. stocks up 9.7%, a nice steady climb with February really being the only off month year to date. And what we're really seeing here is the old stock market adage, climbing a wall of worry, right? So if we think about all the things we've had to worry about year to date when it comes to the market, geopolitical concerns, the debt ceiling negotiation, inflation, federal funds, the Fed's reaction to that, banking failures, you think about all those things, yet if we take a look, really nice steady climb year to date. And if we look on the right-hand side, we wanted to ask the question, what if we, historically, what does it look like if we start the year with a positive 5 months? What does the rest of the year look like on average? So you can see that for the next 7 months, we start the year off positive. On average, we've historically been up 8.3% going back to 1926. Whereas if we start with a negative first 5 months, the market return on average 5.5%. So, clearly some historical trend there that shows that if the year starts off positive, that could be a really great sign for the rest of the year. So we'll hope that holds true here in 2023. Let's shift gears. Let's talk about consumer sentiment. Consumer sentiment is something that there's a lot of different measures that you're going to see out there that measure consumer sentiment. We're going to look at the University of Michigan sentiment index here. And so what we were interested to see is what do stock returns look like after various consumer sentiment readings. Consumer sentiment is very low right now, and historically what that has shown us is that when we have low consumer confidence index readings, that's historically been some of the best returns for stocks in the trailing periods after that. So if we look at whether it's October of 1990 on the left side of the slide, up 33.5%, or March of 2003, up 35.1%. And if we think about this too, there's also a behavioral component, right? So oftentimes, when people aren't feeling so good, that's historically been a pretty great time to put money to work. When everybody's feeling great, that tends to be priced in, right, to the market. So just something to think about and something that interesting to look at that historically. Let's shift gears and let's talk about a topic that we've been following quite a bit, and that's this really heavy growth tilt in the market. You've got 5 or 10 names really driving the S&P 500 return and a really heavy growth tilt. So if we take a look at the index, right, we see that currently 39% of the S&P 500 is made up of growth stocks, with only 23% in value and the balance in the core box. Historically, these numbers have been much closer to a third, and very level. So this is an anomaly and something that, frankly, is a little bit concerning, right? When things tend to get out of balance in the market, that usually doesn't end well, right? And so that's something really that we have been keeping our eye on, and something as an investor you might want to keep an eye on and consider as well. And especially if we think about this next slide. So what you're looking at right here is we are in the currently the largest growth cycle in history, right? We're over 9 years at this point in time, with growth outperforming other styles. And what we wanted to see was, what does the performance of value stocks look like on the back end of some of these other growth rallies, that we've seen historically. So whether that's 1939 or, more recently 2000. So let's take a look here, and we can see that, value has had really strong performance after some of these other growth cycles. And so, something to consider that history has shown us, it's really difficult to call the timing of these types of events and these types of shifts in the market. So the party may not be over, right? or the party may be really close to over. History has shown it's really hard to call the timing, but it is interesting to see, and to acknowledge, growth has had a really strong run. What could that look like moving forward? And that'll be really interesting to see how that plays out. Let's shift gears and look beyond the borders of the United States, and let's talk about international investing. So if we think about, the investable universe, right, and what you're looking at on the slide here is how much of the total allocation to equities is in international versus domestic. We're only looking at mutual funds and ETFs here, and you can see we're up to about 23% of all equity assets are in international right now, off of the low of 21% in October. What's interesting is that was about the time in October when international started to outperform US. So you can see in some of these other historical cycles, if we look on the right, what you're seeing is international versus US performance. And if we marry these two charts together, we can see that, when we hit lows in terms of what's been allocated to international, that tends to be, historically a sign that international is positioned to potentially outperform US. The inverse is also true, right? When international represents historical peaks in terms of its allocation in total equity in mutual funds and ETFs, that has historically set up a pretty soft period thereafter for international. So again, interesting to see if that takes hold, and something to note, right, that if we're well-diversified portfolio, these are things we're going to have, right? We're going to have some growth, some value, some international, specifically because it's so hard to call the timing on a lot of these things. Last slide, let's take a look at core bonds. Core bonds is something that a lot of folks will consider really boring. I would argue differently. I think core bonds look pretty exciting right now. And if we think about core bonds, and what you're looking at here in this chart is what have core bonds done when the Fed and the federal funds rate has outpaced inflation. And historically, if we look, tends to be a pretty darn good environment for core bonds, with returning 7.5% on average. What does it look like if the Fed funds rate trails inflation? Not as great of a picture, right? Averaging 3.2%. So, again, something to think about. If the Fed, is aggressive and hawkish and gets that number past inflation, history has shown that could potentially be a good environment for core bonds. So with that, I'm going to put some important disclosures up on the screen. Thanks so much for tuning in. Again, the goal of this series is to support the important financial decisions in your workplace retirement savings plan and beyond. And we look forward to having a conversation with you in the future. Thanks so much, and so long.